So the two ways to look at it, right? You look at the headline number and you look at outflows from the Bitcoin ETFs and the Ethereum ETFs, and you're like, oh, tons of money is coming out. But in the grand scheme of things, it's like a couple percentage points of like the money that has gone in over the last 18 months. So yes, the numbers are big, but that's because the numbers have been absolutely massive that went into this product. So the Ethereum ETFs have had about 2.5 billion of outflows. That's the one I'm going to look at real closely here. And one of the things I just want to point out is, again, the flows are small as far as when you look back, but 2.5 billion is a big number. But a huge part of this has to do with something called the basis trade. And a lot of hedge funds love this. Some people are probably used to hearing it more on the treasury side of things. But what you do is you basically sell the month contract, the futures contract for the front month or the second month, and you buy the spot at the same time. And what this does is it's a delta neutral position you can earn in like basically a risk-free rate. I won't say completely risk-free because there are issues, but that yield has gone up to 20% annualized at various different times. Lately, it's been around 10%. Now it's below 5%. And a lot of the money coming out of these products right now is because no one is interested in that basis trade, and that's what they were using these ETFs for. But a lot of the retail, the long-term investment advisors, they're still buying and still coming into these markets.
Yeah, the basis trade seems pretty brilliant. If it works your way, it's pretty brilliant. But let's talk about crypto now in the new year, because there are going to be some changes, including some tax changes that could reshape crypto. There's hopefully going to be a framework from which crypto folks can work within. Is that going to be a tailwind, do you think, for crypto?
Yeah, so there's a lot of concerns here, right? So the main concern is something in crypto that we're going to go down a rabbit hole here, but essentially a lot of the concerns around what's going on with these crypto ETFs and crypto investing in general from institutional investors is it's not clear what's allowed and what isn't allowed. A lot of that was on the SEC and CFTC, and that's what we've been dealing with for the last 2+ years, 5 years really even, around what's going to be allowed in these products and what isn't. What's now next on the docket is like, how is this going to be handled from a tax perspective? There's things known as good income and bad income, essentially things that are accepted by the IRS and things that aren't. And there's a lot of guidance that's coming out from the IRS, supposedly, according to my colleague, that Andrew Silverman, that's basically thinks that this is going to be cleared up in the near future. So one of those things is something called staking yield. So in order to participate in some of these crypto networks, you have to do what's called stake your assets. And basically you're putting them up and contributing to the health of the network, as it would be called. And in return for that, you get an in-kind yield. You basically, if you're doing it for Ethereum, you do this, your money's locked up, your Ethereum is locked up. And in return for contributing to the network, you get that in-kind Ethereum back. The question is that allowed? And that's not really clear right now. So there's these ETFs now, some of those ones I just talked about, those Ethereum ETFs seeing outflows, they're starting to allow for staking yield. So they're going to start offering yield to their end investors. But some institutional investors are like, I can't really take this yield because it might be bad income for my products. So this is all being ironed out right now. And BlackRock and Grayscale and a bunch of these different issuers are handling it differently. But over the next coming weeks and months, or we'll say months, weeks is too optimistic for a government thing, but it should be cleared up.
James, 2026, what are the theme or two that you guys are looking for in the world of ETFs?
Yeah, I mean, the thing that's really big, obviously, one, I think we just talked about it, there's going to be hundreds of crypto ETFs launched, different variations, different leverage, different yield plays, you name it. But the other part of it is that we call it manufactured yield, which is kind of similar to what we were just mentioning. It's like these companies are using derivatives to give you leverage or extreme yield, like sometimes north of 80% by selling like in the money call options on really volatile stocks. So these manufactured yield, and we call them boomer candy, these products where they're going to give you protection on the downside, maybe cap your upside in some ways. Think covered call products. There's these products called buffer products. That is still going huge. It's growing extremely quickly. But at the end of the day, it's active ETFs. Active ETFs are here. They are growing extremely quickly. All the legacy asset managers that you know by name are now launching actively managed ETFs. We actually had some news today that Goldman Sachs is buying one of those companies that started those buffer products, those boomer candy products I was just talking about. So Goldman Sachs is jumping into the ring in a big way. They're still going to be, they'll be a top 20 issuer. They're already a top 20 issuer. We think they're going to go from like 17th right now to 15th with that acquisition. So there's a lot of movement happening. The ETF space is still very aggressive. And it's growing extremely quickly. We're over $1 trillion in flows this year.